In this video, I'm going to do the equity investments, but it's going to be a little bit more complicated than the last one we looked at. The reason is we're working with a portfolio of investments. We have investments in two different companies, and it makes the accounting a little bit more complicated, but yes, you can do this. Hang in there. Let's walk through this one together. Okay, so in year one, the given information I have been provided by is I have an investment in A, I have the number of shares in its price, and the investment in B, same information. And so I have the total portfolio, the initial cost of that was $870,700. And so for the acquisition entry, that one's the easiest one of all of these, is I'm going to simply debit equity investments in cash, credit cash, of that same amount, $870,700. Now, using the equity method, equity investments with no significant influence, we need to show fair value on the investment on the balance sheet. So we're going to need to do an adjusting journal entry to make this happen. So the first thing we're going to do is we're going to do an end of the year valuation, and I'm going to look at the investment in A. I have the same number of shares I started with, but the price has changed. So the fair value, if I had to go out and buy these on the last day of the year, the price has gone down on the A to 23, and it's gone up to 18 for the B stock. So the total value, the fair value that I want to show on the balance sheet is $793,100. So basically I have a problem because I have $870,700 already in the account, but I need it to be $793,100. Now you might think, well, why don't we just go ahead and make a credit amount that will reduce the amount of the equity investment? And there are reasons to not do that. And this one is, believe it or not, it simplifies the accounting if you can use what's called a fair value adjustment account to show changes up or down from the initial investment. So when we get ready to do the adjusting journal entry, we look at the investment account, the total portfolio at the beginning, the fair value at the end of the year one, and what we need is a 77,600 credit, right? So what we're going to do is we're going to do unrealized gain or loss, and in this case it is a loss of 77,600. My fair value adjustment account had a zero balance before I did this. So let's assume this is the first year of doing any investments. And so now this is a contra asset type account, right? And it's going to have a credit balance of 77,600. And so what that's going to look like on the balance sheet is we'll show our initial amount, the total portfolio, 870,700, and then we'll net it out against the fair value adjustment. This might remind you a little bit about accounts receivable, less the allowance for uncollectible accounts, and we show the net amount on the balance sheet, and we show the details in the footnotes. So very similar to that, and we would show the net, and it ends up being fair value that ends up on the balance sheet, and that's what investors really want. They want that relevance of fair value. So far so good, right? All right, now when we get into year two, we've got another complication that's going on with this particular example. So not only are we counting over 2 years, we actually are making a change. We are actually selling part of our investment. So in year two, we sold 19,000 shares of investment in B, and that was at $12 a share. That occurred at the very beginning of the year, and I know it might not make much sense because we just said at the end of the year it had a value of, I think we said, I'm not sure what we said the value was, but anyway, it changed between 2 or 3 days. I don't know. Let's see what it was. Yeah, there's B at the end of the year, 18. So a few days later, it's gone down to 12. Okay, well, we'll work with it. So to record this sale, we're going to show the number of shares times the cash price that we sold them for. We have a cash inflow coming in at $228,000. Now we have to show that that portion of the equity investment is gone. We sold 19,000 shares, and the original cost was $16 per share. So we're going to credit that investment account, thereby reducing the investment account. And then the realized loss in this case, is the difference between the two. Now you might be saying to yourself, wait a minute, we just did an unrealized loss a few days ago, maybe a week ago. Are we double counting the loss? And the answer is no, it's going to work out in the end. Okay, so we'll continue on. We get to the end of the second year, and this is where things get really complicated, but like I said, you guys can handle this. At the end of the year, we have, again, our investments in the A and B company, and notice I have the number of shares, and I've reduced the investment in B down to 5,000 shares. Remember, we started with 24, we sold 19, we have 5,000 left. And we are given the end of the year prices. That's a part of our given amount. And so what we find is that the fair value of our portfolio at the end of the second year is 601. Okay, so what's in our portfolio account? We started with 870, 700. We reduced that by 304. So if you had a T account, then we would show this as a debit balance of 566, 700. How do we want this to look on the balance sheet? We want the fair value of 601 to be shown. So that's what we want, the net investment to be 601. But the equity investment is only at 566, 700. In order for us to make it show up as 601, we want that fair value adjustment account to be a debit. So we will add it on, and that will, if that debit is 34,300, well, guess what? This works out. So I'm simply taking the net amount that I actually want in the investment, subtracting out what's in there, and that's what I'm going to need for my fair value adjustment account, right? Now, this is a permanent account. Uh-oh, we already had something in it. Because at the end of last year, end of year one, we made a fair value adjustment. It's a permanent account. So let's take a look at that. I drew a T account here on the side, and I show that at the end of the first year, we had a 77,600 credit. What we want at the end of the second year is a 34,300 debit. And so we're solving for that. Very much like that allowance for uncollectible accounts. You've done that with when you had to find bad debt expense. Okay, so in order for us to get this to this amount, what we're going to have to do is basically add these two amounts. The amount of the debit needs to be 111,900. So therefore, that's what we're going to need in the adjusting journal entry. Okay. Now, you might need to pause this, go back and try this over again. Hopefully it's making sense. Ask questions as you have them, but let me finish out this problem, okay? The adjusting journal entry for the end of the second year. We show the fair value adjustment account, which is the permanent account, with the debit of 111,900. We show the unrealized loss of the exact same amount. And when we do this entry, here is our fair value adjustment account. Now we've got fair value adjustment at what we want. So we have our portfolio account is at 566, 700. Our fair value allowance is a debit balance of 34,300. And so when we net these together, we will end up with 601,000, which is fair value. Okay, the last part of the problem you may have on homework also is saying, let's look at the whole picture together. The total effect on earnings in both years. And so we see that at the end of year one, we did have a 77,600 loss. At the year two, in the beginning, we had a 76,000 realized loss. And like I said, it felt like we were double counting. Well, the way this kind of pans out is that when we fix that last adjusting journal entry, that unrealized gain loss account, we have a gain of 11900. And the total effect ends up being, believe it or not, totally appropriate if you want to do the math and double check everything. But the total effect from the beginning of having this to the last day is a loss of 41,700.